Imagine you were a brand new trader, fresh out the womb, and you wanted to learn how to make money trading stocks just like the big boys. But you wanted just one place, one video series to learn absolutely everything. No bulls, just pure knowledge. AZ'd every topic, a complete blueprint on how to learn the market from a complete beginner's perspective. Well, that is what you're watching right now. This is the part 2 of this series. Let's not waste any time, let's get straight to it. First things first, we need to go over some common trading terminology. Us traders have these common vocab words. That means specific trading terms. It is almost like a secret handshake in a way, but if you are a new trader, you definitely have to know what these terms mean, especially if you are going to watch this series, because I'm going to say them all the time. First term is long. To put it very simply, when you are long on a stock, that means you make money as the chart is going up. So if you buy stock at $10, that means you are in a long position. And if it goes to $20, you made money. Pretty simple.
Okay, that makes sense.
The complete opposite of that is a short. A short is when you make money as the chart going down. Again, I'll try to explain this as simple as possible. Essentially, what you're doing is this. Say if the price is at $10, you then ask your broker, hey, can I borrow 5 shares of stock at $10? I promise I'll give it back. They say, yeah, sure, why not, homie? So you now have $50 worth of short shares, 5x 10. So what you want is the price to go down. Because if the price goes down to say $5, you can then buy back 5 shares at $5, totaling $25. So you got the 5 shares of stock cheaper than what you borrowed them for. You then do a little switcheroo, give the shares back to the broker, just like you said you would, and then you can keep the rest of the profit. So in this scenario, you would have made $25. Hopefully that makes sense. So big picture. Long positions, you make money as the chart goes up. Short positions, you make money as the chart goes down. Next is bulls and bears. If you're completely new, you would probably have heard traders say this before, and you thought to yourself, why is there animals in the stock markets? Yeah, it's weird. I don't know, but it's just the lingo. So basically, if you're a bull, that means you think the market is going to go up in the future, or you take long trades. So oftentimes you'll hear, oh, there's good market news today and I'm bullish. If you're a bear, that means you think the market is going to go down, or you take short trades. An easy way to remember this is when a bull charges at you, they swing their horns upwards. When a bear claws at you, it goes downwards. See, you were a professional trader already. Next, we'll talk about the spread, and this is when it starts getting really juicy. All right, let's go back to the juicy information and cover what a spread actually is. In trading, there is basically 2 main prices, the bid and the ask. The bid and ask refer to the prices at which buyers and sellers are willing to trade a stock. The bid price is the highest price that a buyer is willing to pay for a stock, while the ask price is the lowest price that a seller is willing to accept for the same stock. For example, if a stock has a bid price of $10 and an ask price of $11, this means that a buyer is willing to pay up to $10 for the stock, while a seller is willing to sell the stock for at least $11. The difference between the bid and ask prices is called the spread, which represents everything in the middle. Oftentimes, when you watch professionals traders during live streams, they'll have this moving data on their screen, and it makes them look really cool and professional. Well, this data is called level 2 data, and these moving numbers are the bids and asks. So these numbers on the left are the bids. So as you can see here, the highest price someone is willing to buy this stock at is this price, and this number is the amount of shares they want to buy. The numbers on the right are the ask prices. So this number right here is the lowest amount someone is willing to sell this stock. At the amount between these two numbers are the spread. While we are on this topic, let us talk about the different types of orders. So when purchasing or selling a stock, there are different ways you can do it. I am going to go over 4. There are more order types than this, but these main are 4 you should know. There is market, limit, stop, and stop loss. A market order is you basically saying, I want the stock right now, no matter what the ask price is. You want the broker to instantly buy the stock at whatever the stock is right now. The pros of a market order is that you know for sure you'll be in the trade no matter what. But the con of that pro is you're essentially paying a premium because you're buying that stock for whatever the ask price is right now. Next is a limit order. A limit order is you basically saying, if the stock hits this price, I want to buy it. So say, for example, a share of stock is at $50. You can put a buy limit order for $40. That means your broker will only purchase that stock once the price goes down to $40. Once it hits 40, it'll purchase it automatically. The pros of a limit order is that you're essentially getting the stock at a cheaper price, but the con of that pro is you may not get filled because there are going to be some scenarios where the price doesn't go down to your limit order and you will miss out on the trade. Next is a stop order. A stop order is kind of the opposite of a limit order. Essentially, a buy stop order is you saying you only want to enter a trade if the stock goes up to a certain price. For example, if you have a stock consolidating or moving sideways in a range and the top of this range is at $50 and you only want to enter into this stock once it breaks that range at $55, you would create a buy stop order for $55. Once the price breaks this range and reaches $55, your broker will then purchase the stock. Next is the 4th and final order type, which is the stop loss order. And this arguably the most important one. Unlike the 3 other orders where it enters you into a trade, a stop loss takes you out of the trade. But you say to yourself, if the price ever goes down to 40, I don't want to be in the trade anymore. Well, what you would do is set a stop loss at 40. If price ever goes down to that point, you raw broker will automatically exit for you. So little recap. Market order is you want to buy the stock right now, no matter the price. You want to enter instantly. A limit order is you want to enter if price goes down to a certain price. A stop order is the opposite of a limit order, and you want to enter if price goes up to a certain price. And a stop loss is you want to exit if price goes down to your stop loss. Now, like I said, it can get a little more complicated than this, but for the sake of this video, these are the 4 order types you should know. These are the absolute basics, but it's kind of that one thing that's a little boring, but it's one of those things we had to go over. To be honest, if this series was an AZ series, we haven't even really passed B yet. My goal with this series is to slowly get more and more advanced as we progress throughout the series. So that way, by the time we get to the Z video, you are basically Einstein when it comes to trading. So since you guys smashed the 1,000 like goal last video, let's make this video S goal 5,000 likes. If we get this video to 5,000 like, I will upload episode 3 and we all get a little bit more advanced and start looking at some actual setups. Thanks for watching, and I'll see you guys next time.